ICICIdirect. Joining us today is Shane Vaz to talk to us about gold ETF and why that continues to remain the original store of value. Thank you very much, Shane, for joining us. A quick background about Shane. Shane is a senior product manager at Axis Mutual Fund. He holds a master's degree from the Grenoble Graduate Business School and looks after mutual funds, ETFs, PMS, and EIFs at Axis. He has earlier been associated with HDFC Mutual Fund and Equidebt Corporate Advisors. Shane, great to have you on the show today. I want to talk to you a little bit about gold ETFs and why that continues to remain a strategic play in most investors' portfolio. Of course, the recent few years has all been about the crypto. Can gold ever be replaced by crypto, and why should you not look at crypto and gold in the same fashion and also consider both as a similar asset class?
So I think what's happened of late, at least the last few years, is that Bitcoin and a lot of these other currencies or quasi currencies have come into being with the hope that people can transact in a more efficient and seamless manner. What people have not thought about, or globally, the store of money is backed by democratic institutions and central banks and all of that. And the overwhelming thought by central banks is that it misdirects the purpose of a flat currency, right? Why is the US dollar so popular, or why is gold for that so popular? It's because it is backed by development institutions. It is backed by global central banks and all of these who actually ascribe the value of money or the store of money. So to say that Bitcoin or any of the other cryptocurrencies can unilaterally go and change that status quo is today a little bit far-fetched. And of late, if you see what's happening to these markets, you really can then understand why we can't term that as a store of money. Obviously, there is going to be a lot of regulatory requirements or regulatory changes that will happen. And to my mind personally, I think Bitcoin and a lot of these other crypto assets work very well and in achieving a form of transactional efficiency, but they may not just be yet as money equivalents.
Shane, we keep reiterating time and again that gold is really a strategic call in one's portfolio as opposed to a tactical call. How has gold performed as an asset class?
Yeah, very pertinent question, given that equity markets today are very, very volatile, and Indian investors have increasingly started looking at equity markets as a good investment vehicle. But gold, which has been a historical investment asset class in India especially, has actually not done too bad for itself. Let me give you two reasons for that. Gold today is priced in US dollars globally, right? And as a currency, the Indian rupee, historically, if you look at it, the last 10, 15, 20, 30 years, you've seen that our currency depreciates versus the US dollar. So that number hovers between 3 and 5%, depending on where you look at it. So inherently, just by doing nothing, the gold price in India appreciates by 3.5 or 4% a year. In addition to that, because of inflation, gold is considered a natural inflation hedge. Inflation in India works at about 5-6%. So add those two up, you just by doing nothing, gold invariably appreciates by about 8.5-9%. And that's a very good return for an investor looking at a really, really safe haven asset, right? You would agree, right? Now let's look at it in today's context. If you look at today's equity markets, just look at the last 5 years. The Sensex has given you about 8.5-9% return. Gold has given you actually more than that. So year to date or 5 year to date, you would actually see that gold has actually outperformed vis-a-vis, say, even the Indian equity markets. Now it's apples to oranges, so it may not be a fair comparison at this point in time. But just to give you that number, that it's very, very critical that as investors, asset allocation is very, very critical, and gold should form a part of your portfolio, because invariably gold comes to the hedge when times are tough.
Right. Shane, the last couple of months, in fact, from the start of this year, most asset classes have turned extremely volatile, and predicting any sort of direction has become extremely tough. What are the benefits then of investing in gold during such tough times?
Yeah, so great question leading up to the previous one. If you look at how equity markets and debt markets typically perform, they're almost perfectly not correlated, right? So, for example, when historically the whole premise of asset allocation was when one asset class does well, the other asset class doesn't do well. And that has been true for the better half of the modern economic era. What we've seen of late is that because of a variety of macroeconomic factors, that correlation has broken down. So you've seen a scenario where people have lost money in equity, people have lost money in debt as well. But one segment where people have not lost money, and that correlation still holds true today, is that of gold, right? So why is that the case? Gold as an asset class is devoid of monetary policy. There is no linkage to monetary policy in the pricing of gold. Gold is a resultant factor of people's perception of value and that store of value, which we spoke about earlier. And how is that value ascertained? That value is ascertained because of the collective market of gold. So gold has a finite supply. Gold has a varying degree of demand. As the demand goes up, the price of gold proportionately goes up. And more recently, because of all the geopolitical crisis, all the worries about US dollar being the most safe currency in the world, reserve currency in the world, that perception that gold is a better asset class or an alternative asset class to safeguard the wealth of nations, as it may be seen, has become more and more important. You've seen that with Russia buying out gold. You've seen our own Indian central bank buying a lot of gold over the last year or so. Why is that the case? It is the case because gold will always have that perceived store of value, and that is what drives individuals like you and me, institutions, and even economies world over, democratically elected economies, or even dictatorships, and all of these type of economies, driving them towards the natural perceived store of gold. So as an investment class, gold makes a lot of sense because regardless of what happens, gold will adjust its valuation depending on factors that are not often linked to monetary policy. And that's why I think there are a lot of inherent benefits to investor portfolios when it comes to gold. Yeah.
Shane, as Indians, gold has always been a preferred asset class. But as more and more young people come into the investing cycle, questions such as liquidity, the true cost, wear and tear are some of the cons that work against physical gold. How critical is it when one looks at gold and looks at investing in gold through the financialization route? So what I really want to know is, how does ETFs become the chosen route when investing in gold versus maybe physical gold?
Yeah, very, very pertinent question. Thanks for asking that, Samina. In today's world, if you were to look at owning gold as an asset class, one way of looking at it is through physical gold. But over time, today you have a whole range of opportunities to buy gold in more tax efficient manners and in more efficient manners in terms of costs, hidden costs that I would like to talk about. I've been going around whenever we talk about gold, with regards to ETFs, we talk about this invisible cost that often investors and owners fail to consider while determining what mode or what medium of gold ownership works very, very well for them. Today, you've got Digi-gold, issued by gold jewelers. You've got a gold monetization scheme through the sovereign gold bond scheme. You've got the gold ETFs as well. So all of these have got their own pros and cons. The underlying pro for each of these financial assets is that there is a hidden ownership cost in terms of physical gold. When you buy and sell gold, there is a markup fee that a gold jeweler will charge you. That markup fee is effectively either a making charge, if you're looking to convert like a gold bar into say gold jewelry, or for example, if there is a standardization issue. So if you were to look at maybe 20-30 years back, gold was not standardized. Today you have BIS hallmarking that is done for gold. But if you were to go and tell your jeweler that, I'm giving you old gold, which is not BIS hallmark, he will add a premium or charge you a discount to kind of convert that gold into a more holistic or more tradable gold, right? Then in addition to that, there are state taxes which are levied upon every time you kind of buy and sell gold. Then while owning gold, you have to store it somewhere. So there is a locker charge, or there is insurance that is associated with it. And all of these costs, although they might be very minuscule, they add to the cost of ownership. In comparison, a gold ETF, which we are here to talk about, gold ETFs are a lot more hassle-free because all of this gets taken care by the manufacturer or the mutual fund house that is offering you a gold ETF solution. The only cost that you face in buying or selling a gold ETF is the brokerage charge. That because today, if you were to buy a gold ETF, you have to buy them on an exchange, and you would go through a broker, and hence there is a marginal brokerage charge that a broker will charge you. Post that, there are no incremental ownership charges. The quality is managed by the AMC. The insurance is managed by the AMC. The fund running charges are taken care of as part of the ETF scheme itself. So the end point for the investor is that he's getting the allocation or the exposure to gold without having to bear down on any of these hidden or incidental costs. Now, also you may consider, some of the most savvy investors will talk about something called tracking error. What is tracking error? Tracking error is, in mutual fund parlance, the difference between the movement of gold as your investment, which is the gold ETF in this case, versus the actual or true price of gold. I would like to tell you about why tracking error may not work the way it should. Today in India, you've got 4 major centers wherein gold is traded. So you've got Mumbai, Delhi, Madras, and Calcutta, and each of these places, gold is traded at a different price. Why is that? It is because of transportation costs and other logistical vagaries that affect the storage and transportation of gold. What we as an AMC do is we centrally source gold from wholesale markets, and then we purchase that for you. And that in effect makes it more efficient for you as an endpoint customer. So today, if anybody comes even with a 50 rupee investment to a gold ETF, you get the same benefits as if you were buying 100 tons of gold. And that is why a gold ETF makes a lot of sense for investors today, vis-a-vis other forms of gold.
Right. Shane, very lastly, the government has also launched sovereign gold bonds. How does sovereign gold bonds compare to gold ETFs, and what should one choose?
Yeah. So the very, very relevant question, because today our primary competition is the sovereign gold bond scheme. The ownership of gold between, say, a sovereign gold bond or a gold ETF can vary for different types of investors. For investors who are looking at gold for a very long period of time. So today, for example, the sovereign gold bond scheme is an 8-year scheme wherein once you buy it, you are not allowed to trade that for the first 5 years. And post that, you are able to liquidate that on an exchange. In addition to that, if you were to buy the sovereign gold bond scheme, you get an incentive, which is the 2.5% interest per year on the predefined price of gold. What that actually does, however, is that it compensates you for that illiquidity premium. So the objective of any investment today is to have a very liquid portfolio, right? So tomorrow, if for any reason you need money, what is your first source of that pool? That is your investment. So by virtue of locking up your investments in the sovereign gold bond scheme, you may not be able to liquidate, a portion of your portfolio. In comparison, the gold ETF is a come as you go, right? The come as you go acronym that we typically use. You come whenever you want, you go whenever you want, or the only cost for you is the brokerage, the in and out. Of course, there is the taxation element to it. So the more frequently you trade, the more incidence of taxation you will have. But what the gold ETF effectively tries to do is give you a highly liquid sense of ownership in a high quality asset. That doesn't mean to say that the sovereign gold bond is not a good investment vehicle. It is good, but it is good for people who are committed to holding that for the duration. One other aspect that I'd like to talk to you about is the liquidity of the sovereign gold bond scheme. Today, the liquidity on the sovereign gold bond scheme is not very active. Why? Because the primary owners of sovereign gold bonds are retail investors who are looking to lock it in for a very long period of time. So if you were to go and buy it on the exchange, for example, a sovereign gold bond would trade at a very, very wide spread or wide margin, which would inherently cost you a hidden impact cost, if you may. So obviously there are pros and cons. You have to identify what type of an investor you are. So for shorter term investors, typically a gold ETF may make a lot more sense. For those investors who are very committed as investors to the gold to gold as an asset class, the sovereign gold bond scheme may make a lot of sense.
Right.
Yeah.
So liquidity and flexibility are the two very important attributes of gold ETF. And if you are looking for a liquid asset class, which is specifically gold, then I think gold ETFs would be the chosen vehicle to invest in gold.
Yeah.
Great talking to you, Shane. Thanks a ton for joining us today on the show and talking to us about why gold continues to remain the original store of value for investors worldwide. Thank you.
My pleasure, Samina. Nice talking to you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.